Hello friends, welcome to IAS ABHIYAN YouTube channel. This is our part 2 series where we are discussing on important economic terms. Sovereign Gold Bond Scheme. The Sovereign Gold Bond Scheme was introduced by the Government of India in 2015. The Government of India has introduced these bonds to help reduce India's over dependence on gold imports. The move was also aimed at changing the habits of Indians from saving in physical form of gold to a paper form with sovereign backing. The bonds will be restricted for sale to resident Indian entities including individuals, Hindu undivided families, trusts, universities and charitable institutions. The bonds will be denominated in multiple of grams of gold with a basic unit of 1 gram. The tenure will be for a period of 8 years with exit option from the 5th year to be exercised on the interest payment dates. The minimum permissible investment limit will be 1 gram of gold while the maximum limit will be 4 kg for individual, 4 kg for Hindu undivided family and 20 kg for trusts and similar entities per fiscal notified by the government from time to time. Next is Monetary Policy Committee. The RBI has a government constituted Monetary Policy Committee which is tasked with framing monetary policy using tools like the repo rate, reverse repo rate, bank rate, case reserve ratio. The Monetary Policy Committee has been instituted by the Central Government of India under Section 45ZB of the RBI Act that was amended in 1934. The MPC, that is Monetary Policy Committee, is entrusted with the responsibility of deciding the different policy rates including marginal standing facility, repo rate, reverse repo rate and liquidity adjustment facility. The committee will have 6 members. Of the 6 members, the government will nominate 3. No government official will be nominated to the MPC. Monetary policy instruments are of 2 types, namely qualitative instruments and quantitative instruments, which is used by Monetary Policy Committee. The list of quantitative instruments includes open market operations, bank rate, repo rate, reverse repo rate, case reserve ratio, statutory liquidity ratio, marginal standing facility, and liquidity adjustment facility. While the qualitative instruments includes change in the margin money and moral suasion, which refers to direct action. Next is business correspondents. Business correspondents are retail agents engaged by banks for providing banking services at locations other than a bank branch or ATM. Banks are required to take full responsibility for the acts of omission and commission of the business correspondents that they engage and have therefore to ensure thorough due diligence and additional safeguards for minimizing the agency risk. As per the RBI guidelines, the products provided by the business correspondents are small savings account, fixed deposit, recurring deposit with low minimum deposits, remittance to any business correspondent's customer, microcredit and general insurance. Business correspondents have to do a variety of functions like identification of borrowers, collection of small value deposit, disbursal of small value credit, sale of micro insurance, mutual fund products, and receipt and delivery of small value remittances, creating awareness about savings and other products, education and advice on managing money and debt counseling, etc. The banks may engage the following individuals or entities as business correspondents. Individuals like retired bank employees, NGOs, mutual fund investments, or institutions set up under Societies or Trust Acts and Section 25 companies, cooperative societies registered under Mutually Aided Cooperative Societies Act, post offices, companies registered under the Indian Companies Act 1956 with large and widespread retail outlets, that is outlets, excluding non-banking financial companies. Next important economic term is round tripping. What is round tripping? Round tripping refers to money that leaves the country though various channels and makes its way back into the country, often as foreign investment. This mostly involves black money and is allegedly often used for stock price manipulation. Round tripping is often done through a series of transactions that don't have any substantial commercial purposes, which makes it fall within the trappings of GAR, that is general avoidance of anti rules. Next term is balance of payment. According to the RBI, balance of payment is a statistical statement which shows the transaction in goods, services, and income between an economy and the rest of the world, changes of ownership and other changes in the economy. In that economy is monetary, gold, special drawing rights, and financial claims on and liabilities to the rest of the world, and unrequited transfers. The transactions in balance of payment are categorized in current accounts showing export and import of visibles and invisibles, capital account showing a capital expenditure and income for a country, errors and omissions. Sometimes the balance of payment does not balance. This imbalance is shown in the balance of payment as errors and omissions. Balance of payment is compiled using the double entry bookkeeping system consisting assets and liabilities. Our next important economic term is capital adequacy ratio. Capital adequacy ratio is the ratio of a bank's capital in relation to its risk-weighted assets and current liabilities. It is decided by the central banks and bank regulators to prevent commercial banks from taking excess leverage and becoming insolvent in the process. The capital adequacy ratio, also known as capital to risk-weighted assets ratios, that is CRAR, which is used to protect depositors and promote the stability and efficiency of financial systems around the world. So basically, capital adequacy ratio is the ratio of bank's capital in relation to its risk-weighted assets and current liabilities. It is decided by the central banks and bank regulators. Next is risk-weighted assets. Risk-weighted assets are used to determine the minimum amount of capital that must be held by banks and other institutions to reduce the risk of insolvency. The capital requirement is based on a risk assessment for each type of bank asset. For example, a loan that is secured by a letter of credit is considered to be riskier and requires more capital than a mortgage loan that is secured with collateral. So risk-weighted assets are used to determine the minimum amount of capital that must be held by banks and other institutions to reduce the risk of insolvency. Next economic term is short-term capital gains tax. The gain or profit from the sale of assets is classified as a capital gain. Short-term capital gains tax is the tax levied on profits generated from the sale of an asset which is held for a government-defined short period. The short-term period differs for various items. If an asset is held for less than 36 months, any gain arising from selling it is treated as short-term capital gain tax. And if an asset is held for 36 months or more, any gain arising from selling it is treated as long-term capital gain. Next is customs duty. Custom duty is levied when goods are transported across borders between countries. It is the tax that governments impose on export and import of goods. Customs duty is beneficial for many reasons. For instance, it ensures a country's economic stability, jobs, environment, among others. It regulates the movement of goods in and out of the country. Custom duty keeps a check on restricted items. So basically it is levied on when goods are transported across borders between countries. It is the tax that governments imposed on both export as well as imports of goods. Next is Securities Transaction Tax, also referred to as STT. Securities Transaction Tax is a tax that is levied on the purchase or sale of shares and other tradable securities of the companies listed on the stock exchange. The STT or Securities Transaction Tax is governed under the Securities Transaction Tax Act, which is levied on specially listed taxable securities including equity, derivatives, units of equity oriented mutual fund. The Securities Transaction Tax was introduced in Union Budget 2004, and this transaction tax was imposed in lieu of lower tax on short-term capital gain and a nil long-term capital gain tax on equities. However, in 2013, the tax rate was cut following years of protests by brokers as well as the trading community. Thanks for watching.